Welcome there, Investorholics, to another ETF Spotlight review. Today we will be looking at AAA, which is a BetaShares Australia high interest cash ETF. And this one obviously is brought to you by BetaShares. So if you're looking for a little bit of portfolio diversification and regular monthly income from your portfolio, high quality cash deposits at some of the major Australian banks. So yeah, look, not high interest or anything, but it's a good way to park your cash if you don't want to put it in the bank account. Hang around and have a look at this one. Thanks, guys. Okay, let's crack on into this one. So AAA aims to provide exposure to Australian cash deposits with attractive monthly income distributions that exceed the 30-day monthly bank bill swap rate. Looking at bank accounts held with National Australia Bank, Bendigo and Adelaide Bank, Bank of Queensland, Rabobank, Bank of Tokyo, Mitsubishi, JP Morgan Chase, Citibank. So 4 or 5 different major banks there that holds deposit accounts for the ETF manager. Why would we bother doing this one? So it gives us attractive income, and that one's paid monthly. Generates attractive income on cash deposits with income paid monthly at a rate competitive with the at-call bank deposits and term deposit rates. Convenient and liquid. There's no need to open a bank account or lock up your funds away in a term deposit or seek honeymoon rates. So you pretty much get the best rate here. It's what they're promoting anyway. Simple structure. So AAA owns nothing other than cash deposits in major banks, providing high levels of capital stability. So pretty much you put your money in, you're going to be able to get your money out effectively. But yeah, you do need to time when you actually need to take your money out. It's best to be taking your money out after they've paid the interest, obviously. So that's one to keep an eye on. Okay, we got a net asset value of $50.07, trading equal to the net asset value here. When I looked at the price at $50.07, market cap of roughly $1.8 billion. Management fee per annum is 0.18%. As we sort of mentioned before, you're going to get a monthly distribution. Dividend yield sort of between 2.5 to 3 at the moment. We're going to see an increase today from the RBA, I'm expecting, so you're probably going to see that jump up to maybe as high as 3.5 potentially. So cash-based ETF has more in common with a bank account, as we kind of touched on before, than other ETFs, like VAS or whatever. They don't hold any underlying shares at all. Instead, each unit represents a cash-based asset, which is not too much more than money in the bank account. So that's kind of what we like, the flexibility, take it in, take it out. You're just paying the fee to trade, I suppose. At times of uncertainty, such as look now, I suppose, with the outlook for the economic growth, as it sort of deteriorates, and sort of a lack of confidence from investors in the performance of equities and other different types of assets. Exposure to fixed income becomes more important. So people are trying to protect their capital, their principal, I suppose. So this is an interesting way to do it. As always, we're constantly doing our research, so please have a look at BISEC and Bill, BILL. There are also other different alternatives to this one, so cash-based sort of things. Yeah, effectively function as a bank account. Okay, so just a quick summary of sort of performance. As I kind of touched on before, there's a list of banks there on the right hand side where the money or the cash is held, in which accounts or which banks I should say. Performance, I mean, as you'd expect, you know, you're not looking for a great deal of outperformance here. Really all you're looking for is capital preservation. So this is one to keep an eye on anyway. If you're looking for capital preservation, I mean, you're not keeping in front of inflation by using these type of products, but I suppose it gives you flexibility to be able to take your money in and out of the market whenever you like, and you know you kind of got that sort of added protection. The capital is going to be there. You know, it's an alternative to locking up in a bond or whatever, you know, or return deposit. So for me, I mean, these type of things have their place, but I mean, I wouldn't necessarily go out running to find this. I mean, I like a little bit higher interest rate or higher dividend for my capital invested. So it probably isn't for me. But I mean, if you're ultra conservative and you're looking for just somewhere effectively to hide your money for a little while until the market sort of becomes a little bit more predictable, then this may be something that's worth looking at. But as always, make sure you go back and do your research and have a look at those other alternatives. This is only education, of course, so you know we have to make sure that we're doing the right research and speaking to your accountant, your financial advisor, and those type of people. But for me, I think I'd probably pass on this one anyway. Thanks, guys. Hope you enjoyed.